Risk management in trading is the topic of today's presentation. And if you're somebody who trades stocks or forex or commodities or options, then you're going to want to watch this because this tutorial on risk management in trading is going to save you a lot of money. So there's two reasons that we put this together. First, because we couldn't believe the absolute tripe that's out there when it comes to YouTube videos talking about risk management. So for example, the top risk management video out there is titled Risk Management in Day Trading. Well, that's rather ironic because the best way to get rid of day trading risk is not to day trade. And we'll talk a little bit about duration. But this individual implies that watching YouTube trading videos is how you become a profitable trader and that the difficult part in trading is not necessarily making money. Of course it's not, but keeping your profit. Talks about some example and how they got dumped faster than her ex-husband dumped her, no doubt. So moves on to talk about using stop losses, trading on a $10,000 book, and then starts pushing her course. If you can decipher between that and all the drivel of ads that are being spouted off this video with individuals peddling whatever junk it is that they think you'll buy in hopes of becoming some BSD Gordon Gekko. The truth of the matter is that you're not going to. Now, the second reason we wanted to do this video is because I'm fairly qualified to talk about risk, and you need to be careful when people tell you that. So just because they went out and studied risk doesn't mean they're going to be telling you what you need to hear. So my pedigree, I started out in software quality assurance for the first half of my career. I then did an MBA with a finance focus, worked my way into Morgan Stanley in the indexing and risk management division. I then completed a master's in investment management with a risk focus, and I learned there that the academics don't really teach you about how to actively manage risk. They teach you concepts that you just parrot, and until you actually get your hands dirty, you're not going to learn how to manage risk. So then I worked for a decade, half of that at an officer level, the world's leading risk management firm. So that's where I started to learn about risk. And I'll tell you where I learned the most about risk. I made more mistakes in the market than you can shake a stick at. And that's really how you learn the importance of having risk management. And it's when I stopped speculating and I started investing that I started to accumulate real wealth. Now, this gentleman you see here is an absolute legend. He's referred to as the Swiss machine. And you see him here climbing the deadliest mountain in the world. So this is Annapurna. If you climb that mountain, you have a 67% chance of not dying. In other words, 1 out of 3 people that attempts that summit dies. So it's very, very difficult. And you can see him here climbing that with what appears to be no concern for risk. And he's actually one of the most accomplished climbers ever, and perhaps the most notable accomplishment that he had was here in the Swiss Alps. You can see this is in German called the Murderous Wall. It's the north face of the Eiger that's killed 64 people. And Mr. Steck's claim to fame, this is a classic climb for mountaineers that can take 2 to 3 days for experienced climbers. Mr. Steck set a speed record of under 4 hours on that face that you see there. A year later, he did it in 2 hours and 47 minutes, and he proved that speed ascents were the safest and most aesthetic way for a human to summit a peak. What did he do there? He reduced his duration, and in doing so, he was able to do things that nobody else could. Now, he didn't manage risk quite well enough. He fell to his death on a benign training exercise near Everest, so it just goes to show. And in interviews, he knew the risks that he was taking because an avalanche or a falling rock can take anybody out. He knew the risks and he took them on, and there's a certain amount of respect that you have to have for people like that. Now, trading is also about duration, and intraday traders or day traders will take the Uli Steck approach. They're in and out the same day, and they believe that minimizes risk by not exposing themselves to times when the market isn't active. And of course, forex is active 24/7, so that's an exception. But when you think about the stock market, when the stock market closes, intraday traders won't have their positions open. So typically, they're commanding a lot of leverage because they're trading in such a short time frame. And when you start leveraging up, that creates a lot of risk. Then you have swing trading. I'm going to put an article in the description of this video that talks about why we think you should avoid swing trading like the plague. And you can read that separately. It breaks down the reasons why you'll never become a Gordon Gekko. Then you have medium-term trading, which would be, some would refer to this as momentum trading, measured in years. And then you have what we involve ourselves with, which is long-term investing, set it and forget it. You measure your time frame in decades. You check in with tech stocks, well, we do anyways, once a year, barring any major events. For our dividend growth stocks, we almost never check in. Now, you're going to understand as you progress down the path of managing your own wealth that sleeping well at night is underestimated. And the older you get, the more that you realize that. Now, we're going to talk to 3 types of people in this video in regards to risk management. The first would be retail and institutional traders. Well, no institutional trader is watching a video on YouTube learning how to become a better trader. That's just not how it works. Nor are these individuals selling some course that's going to teach you how to generate alpha in the markets. That's all a bunch of bullshit. So you need to be very careful, again, about people with pedigrees that say, hey, I'm selling something that can make you a successful trader. Now, if you decide to dabble in trading, you'll very quickly, hopefully, learn about stop losses. In that lady's video we mentioned earlier, she talked about stop losses. Very simple. You put a fixed price, a certain percentage under the price that you purchased the asset at, or let's say opened your position at, and then that automatically stop losses out the position. So you move out of your position without losing a certain amount of money or percentage of that position. These can also be trailing, meaning if the asset price goes up, that will move up alongside that asset price. And when the asset price goes down, then you capture some alpha. Now, for retail investors, medium to long term, and we sit in the long term, the way that you manage risk is through diversification, and you start at an asset class level. So there's a video that we did specifically looking at asset class allocation, and I'll link to that in the description of this video. And the idea is that you start to break down your wealth between stocks, real estate, alternative assets, fixed income, funds, etc. And there's a lot of ways that you should be slicing and dicing this picture of your wealth. So you can look at value versus growth. That's an approach we take. So we have a tech stock portfolio, about, let's say, 15%. Then we have a value portfolio that's about, 54%. So we overweight value. That's because we're risk-averse investors. Size. We give size a premium in our minds because bigger companies have economies of scale. Then you look at industries, so you want to be spread out across industries. And then there's momentum, there's country. So a lot of people commit the sin of only investing in companies they know in their own country. That's called domestic bias. So if the U.S. has a bad time in a particular decade, then you won't be taking advantage of the other countries where they may not be undergoing such turmoil. And then you have commodities as well. So stocks or any asset that you hold can have exposure to commodities. Now, I wanted to touch on institutional risk management because this is what I spent a decade working in. And it's very cool stuff. So institutional investors need a holistic picture of all the assets they have under management: equities, fixed income, real estate, currencies. When you aggregate that, we built a model called the BARA integrated model, and my teams built the equity component of that model, and we assembled it all together, and BlackRock or Vanguard would take that across their entire organization and get a picture of all their assets. And what they could then do is some very cool stuff. So they could run stress tests, and we had 20 or 30 scenarios. You can think the Iraq War or the oil crisis or the 2008 crisis. All these are modeled because we know how assets performed. We know how every single asset out there, because our coverage was phenomenal, how they performed in these crisis events. So then you could back test your own portfolio against that. Super cool stuff, right? Now, many of the reports used by institutional investors are to appease regulators or clients, or particularly the risk management team that should be paying attention to this stuff. But what was particularly interesting in showing how risk management works is this concept of value at risk, these VAR reports. So let's talk a little bit about risk managing in trading, just the basics, okay? Margin is added risk you should not be taking. So leverage, margin, however you want to call that. If the house extends you credit, don't take it. Don't trade on margin, all right? So you should automatically make that a rule because you're going to get yourself in some serious trouble if you do that. Now, If you stay away from margin, you'll always enter a position knowing what's at stake, the capital you committed to the trade. And of course, on a short position, that's going to be different, but typically on a short position, they probably make you have margin. I'm not sure for some brokerage firms, but I recall that being the rule because there's potentially a lot that you can lose, a lot more that you can lose from a short position than what you put up at stake. Now, the most important aspect of risk management is always knowing what you stand to lose, okay? And in institutional investing, this concept of value at risk, it said, what's the maximum amount I could lose at a 95% or whatever percent confidence level? So you say, there's only a 5% chance that something really bad could happen. So this description here tells you how it works. If a portfolio of stocks has a one-day 95% VAR of $1 million, that means there's a 5% probability that the portfolio will fall in value by more than $1 million over a one-day period if there is no trading. So if you're somebody responsible for managing risk and something really bad happens, you take that VAR report over to your manager and say, look, there was only a 5% of this chance of this happening. What will have happened is some long-tail risk event, right? And they'll say, well, were you looking at that in your VAR reports, right? And this is what we call CYA, covering your ass, right? So what you don't want to do is be the Redditor who woke up with $75,000 in their account and didn't know how he made it. That was a classic story. It could have been 750. I don't recall the number, but it was some big number that this individual couldn't tell people. If you can't tell anyone how you made money, you sure as hell don't know what value you have at risk. So you need to always, the most basic rule of risk management, always understand what you stand to lose. If you can't articulate that, if it's not intuitive, then don't get involved. Now, you can trade various asset classes, stocks being the most common. These gain typically intrinsic value over time. So trading on the long side would clearly be more beneficial in the long run. You've got options. These minimize your duration. They increase your risk through leverage. And as I recall, brokerage firms require margin accounts, at least the ones I've used, to trade options. And I would highly recommend that you don't get involved with this stuff. You're going up against institutional algos on the other side of the trade, and the house is always going to win. So you may have some lucky event. I've done the same thing myself. There was a pharmaceuticals company called Elan back in the day, and I remember I made a whole bunch of money and thought I was some BSD. The reality was it was pure speculation, right? You can use options for things like hedging or covered calls for income, and we may do some tutorials on some of the, let's say, less risky methods of using options. But anybody that talks about options trading or binary options, please don't run away from stuff like that. Then you have forex. This is pure speculation. So we hold forex just for some diversification effects in an international portfolio. Again, thinking about duration there. Commodities, these usually have an intrinsic value that remains range bound. So again, lots of speculation. Crypto doesn't count. We don't even talk about junk like that. So when you look at volatility, this is one thing that comes up whenever we talk about risk. And I remember learning this in some of the first days of my job at Morgan Stanley, was that volatility equaled risk. And I had to think that through. So the most frequent used measurement of investment risk is standard deviation. Now understand that there will be academics or people in finance, accomplished people that will disagree with this or interpret it differently, but this is pretty standard stuff. So standard deviation is a measure of risk based on how widely an asset's price fluctuates over a given period of time. So securities that have a wider range of fluctuation and unpredictable movement, they carry more risk. That's intuitive, right? So for example, a growth stock, and you can, if you trade tech stocks, if you invest in tech stocks or trade tech stocks, you'll know that they experience a lot of spikes and reversals. The direction's always uncertain. That's why people always ask, why is a certain stock price falling? They don't care if it goes up, that's expected, but it falls, they're quick to ask Google. Now, there's a measure for this called beta, and it measures a stock's volatility relative to a benchmark. And the whole point of this is to say that value stocks are typically lower beta. They're less volatile. Growth stocks are higher beta. tech stocks are very risky. So on our channel, we talk a lot about tech stocks, and we have to warn people that they are very risky relative to other stocks. Not all stocks are created equal. Now, this picture here you see on the right, this is actually pinned on our Twitter account. By the way, we have Twitter. It's Nanalyze Tweets, so you should go sign up because we send out a lot of interesting stuff on our Twitter account. But this is kind of a takeoff on, well, it wasn't Gandhi that said it, but someone paraphrased what someone lesser known said, and it goes something like, first they ignore you, then they laugh at you, then they fight you, then you win. And this is kind of a joke there. It says, first they laugh at you, then they laugh at you, then they laugh at you, then they laugh at you. And it's the individual, and you could just see in this individual's face, you could feel his pain of having continuously lost money in the market and just turning every which direction, trying to figure out some panacea to his problems. Now, the typical path of a retail trader goes something like this. It's looking for a quick or easy way to make money. I know I've been there. Typically starts out with a little. So maybe it's a $1,000 tax return, and this individual immediately disregards that individual's YouTube video that cautions correctly that you should only risk 1% of your capital on a trade, and you realize that how little that actually is and that you need money to make money, so you eventually start taking on more risk, and eventually you lose all of your capital. Now, what will usually happen then is that you'll start purchasing the tripe being peddled in some of the ads running on these risk management and trading videos. You'll lose more money, and eventually you'll capitulate. You'll come to one of two conclusions. One, that you're incapable of investing your own money, which is false. Or two, that there's a big difference between speculating and investing. So, for what it's worth, if you have money to invest right now, you do, otherwise you wouldn't be trading, then you need to put it to work. Why? Because time is the single most important factor for long-term wealth creation. This has been studied to no ends. The Fidelity example is a classic. When Fidelity audited all their retail accounts, they found that the highest performing accounts were those where the owner of the account either forgot they had an account or they died. And that tells you it's about time in the market, not timing the market. The earlier you start, the better things in life you're going to enjoy later on. You need to be an investor, not a speculator. Now, you're going to notice one thing. There's no ads in this video, or if there are any ads, they're minimal because we run with the absolute minimum number of ads. Why? Because there's a lot of rubbish being peddled, and in that video that we talked about earlier, we noted several ads. One involving a Nobel Prize-winning formula that lets option traders know where stocks will move in advance, okay? And then this other individual peddling a system of trading, and you can always tell there's a big red flag when people talk about who has time for that. He says, well, you could study and you could go learn and go through the hard way, or you could just take a shortcut and purchase my course. This individual used to work at Goldman Sachs and should have some integrity because he knows. There was another ad talking about how you can take profits from a trade but incur no risks as a prop trader. So this is all garbage. That what happens are people that go to this channel looking to learn about risk management think that they've found some answer to their problems when the simple answer is you shouldn't be trading, you should be investing. So to conclude, you can be the biggest big swinging dick known to man, but if you don't tell people the truth about trading, you have no integrity. And that's what you'll see all these individuals out there doing. They're pushing some course that teaches you how to be a better trader instead of telling you that's not how you become wealthy. Unless you're trading for fun and you're a millionaire and you're trading for fun, you're somebody who's trading because you think you can make money by doing so, and the truth needs to be told. Don't listen to people trying to convince you that being a trader is better than being an investor. Now, if you're going to do it anyway, and many people will, go make those mistakes and capitulate as quick as you possibly can, and then start investing your money, because time in the market is what creates wealth. Now, if you want to become a better investor, what you can do is subscribe to our channel. Here on the right, you can see the Nanalyze logo there, that round logo. Click that, please, and subscribe. After that, on the left here is a video about investing in 2023. We talk about our own portfolio, our performance in 2022, etc. So you can watch that video next. Thanks so much for taking the time to watch this today.